Hey guys, what's up? Alec back with the daily stock market, and look at that, a huge red day in the markets. We have Ford leading the pack by far, down 12% on the day. So we're going to talk about Ford, and we're going to talk about a lot of other interesting stocks. So before we jump right in this video, just make sure you smash a thumbs up, subscribe with post notifications on, and we won't waste any more time. Let's get right into it. So Ford is the first one up, and we see them down 13% in the last month. Most of that movement was obviously today. So what's going on with Ford? They're still up in the last 3 months. If you guys have been subscribed to the channel for a while now, at least a few months, you remember me talking about Ford when it was at a higher support and resistance of around $15-16 per share. We predicted that it would head back down to around $12, $11 per share. So I still think that Ford has some downward movement to go. I know a lot of people like Ford, so we might have a good buying opportunity coming up in the short term for long-term investors and for short-term to mid-term swing traders. Okay, so Ford could be presenting an opportunity under $12 per share. In the 11s is where I have my price alerts to buy the heaviest. Okay, if we scroll down, we can even see that it has a P/E ratio of 5.0, implying that it's a fantastic deal right now, and a dividend yield of 3.0, implying that it's a great dividend stock also. And if we pull up what analysts have to say about Ford, their predictions in the next 12 months on average is around $15 per share, $28 on the high end. So there's a huge discrepancy between some of the highest predictions and some of the lowest. We have the lowest price around $10 per share, and probably only one analyst is saying that. On average, it's around $14-15 per share. So if we are able to buy in closer to $11 or $10 per share, that will be around a 30 to 50% upside if it hits our price target of around $14, $15, $16 per share in the next 12 months, which I definitely think is possible. We have 5-star analysts from Morgan Stanley, Goldman Sachs, Bank of America, all giving the green light on Ford, saying around $14 in the next 12 months. This was just reiterated 2 days ago as well. All right, and we even have a Bank of America securities analyst saying $28 per share, and that was just reiterated 12 days ago. We can see an article saying Ford stock suffers worst day since 2011 after cost warning, shedding $7 billion in market cap value. Ford Motors suffered its worst singular day in the stock market in 11 years. Shares of Ford closed Tuesday at $13.09 per share apiece, down 12%. The losses come after the automaker pre-released part of its third quarter earnings report and warned investors of $1 billion in unexpected supplier costs. Okay, so that's definitely a red flag. So if we keep reading, we can see that Ford, after the market closed on Monday, said the supply problems have resulted in part shortages affecting 40,000 vehicles, primarily high-margin trucks and SUVs that haven't been able to reach dealers. Despite the problems and extra costs, Ford affirmed its guidance for the year, but set expectations for the third quarter adjusted earnings before interest and tax to be in the range of $1.4 to $1.7 billion. That would be significantly below the forecast for some analysts, who were projecting quarterly profits closer to $3 billion, which would be a 50% cut in half, basically, okay, from what was expected, which is huge. Ford cited recent negotiations resulting in inflation-related supplier costs that will run about $1 billion higher than originally budgeted. Okay, if they're saying stuff like this, is Ford has the guts to actually come out and say it, because they're pretty much cemented in the auto space and have a very low chance of bankruptcy. But just be prepared, because we can see other stocks like GM and other huge automakers like NIO and other American automakers suffering from this as well. They just haven't put it out like Ford has, hoping that it's going to correct itself closer to quarter 3. So that's something that's like a pro tip for people to be looking into if you made it this far into the video, because there's a good chance that other automakers could be running into the same issue that Ford is right now. They're just not speaking up like Ford did. They went ahead and gave us a very big heads up. Okay, so now let's do an update on Netflix. So intraday from pre-market, actually, we saw that it went up around 3% and cooled off. That was just on the day. They're sitting at around $243 per share, by the way. On the monthly chart, they're up 6%. On the 3-month chart, they've been making some moves. They're up 36% now. Looks like they are currently at that resistance of $249 per share, which they set back on August 12th and 15th. So it looks like they're having trouble around that resistance again. There could be a good idea to do a put on them. They could easily head back down to $236 per share. But in my opinion, I think they'll even go down to the support of around 220, 215, and I think they will break back down into the 190 range, or at least go below $200 per share once again. Okay, now that might take a little bit longer, but I do have my price target on Netflix set right around $190 per share. A lot of people think they won't break below this new support and resistance that they set around 220. So a lot of people think they won't go below 220 because they recently just got an upgrade from a lot of analysts. So let's talk about that. Here we see Netflix stock gets another upgrade. Ad-based service could win back lost subscribers. Okay, so this is what analysts are taking into consideration right now. Okay, Oppenheimer analyst Jason Helfelstein. This is just one analyst. We can see lots of other analysts are bullish also. We can see that another analyst is interested in after a 60% wipeout. But this article that we were reading was talking about this Oppenheimer analyst lifted his rating on the video streaming company to outperform from perform, citing the potential for faster growth in subscriptions after Netflix launches its planned advertising-based service, okay, ad-based service. He has a target of $325 per share for the stock's price, while the shares were flat at $240 when this was written on Monday morning. They have fallen around 60% this year. Okay, the analyst ratings change come after another analyst upgraded his ratings on Netflix shares to outperform in line last week, while another analyst, Tim Nolan, raised his ratings to neutral from underperform earlier this month. So we see the cycle right now. A lot of different analysts are all lifting their price targets on Netflix. It could be a bullish time for Netflix. Could it be a good idea for a swing trade, especially if they break under $200 per share once again? There could be a lots of short-term swing trade opportunity as well for Netflix then. Netflix hasn't confirmed the pricing of its ad-supported tier just yet, though late last month, Bloomberg reported the service would cost around $7 to $9 per month, so significantly cheaper than what it is right now, almost 50 to 40% price discounted from where it's at right now. And there's probably a lot of people that would be willing to take that deal that aren't paying for a Netflix subscription right now because it's just too much money. And by the way, that wouldn't include Netflix full catalog. Netflix said on a July conference call to discuss its earnings that it would launch a new tiered service. So the analyst actually said in a survey indicated not only that an ad-based tier would attract new users, but it would also add larger opportunity to encourage past users to resubscribe. More than 40% of the people in the US who have stopped subscribing to Netflix would re-engage at a lower price, he said. Of the 9% of survey participants who said that they never subscribed, 30% expressed interest in signing up at a lower price. Besides the growth in user base, the analyst optimist seems from Netflix's dominant position in the streaming and its ability to sell ads at a cost well above the normal TV average. Netflix attracts a significant audience for releases of shows comparable to award shows and major sporting events. Wow. They're saying a big Netflix original show could attract the same amount of people as something like the Super Bowl or the World Series, for example. Netflix, in my opinion, is a high risk, high reward play. If you can get in at under on $200 per share, the risk is going to be drastically a lot better and the reward will be a lot better. Okay, there's huge reward potential for Netflix to get to even $400, $500, $600 per share. If I'm able to buy at $190 to $200 per share and it gets back to $600 per share in the next 2 to 3 years, that would be around a 200 to 300% gain. So that's my goals on Netflix. That's why I'm bullish on Netflix, but just understand there is risks involved with a stock like Netflix. Okay, so let's talk about one more high risk, high reward stock, and that's going to be PayPal, down 5% on the week, 2% on the month, and it's up 23% in the last 3 months. So it looks a little bit like a Netflix chart here. However, we can see it's closer to the support right now at $91 per share. So the question is, will it break back below? If we see it at below $91 per share into the 90s, then there's a good chance that we'll see it around $85 per share once again. So that's a good price point to have on your radar if you're looking for puts. I would probably open up a put, like trade option, trade put, and then go to like October 14th, for example, buy put. They're pretty expensive right now. I would probably be looking at like this $89 put. Looks like it's only around $380 per contract, but I would only buy that if we saw PayPal with more downward momentum under $91 per share. If it can break into $90 per share, I think there's a good chance that we can sell that put at a good increased price. So I think we can sell that put once PayPal's closer to $86 per share and get a great increase on that contract of probably 30 to 50% on that contract. So if you want more information of when I'm going to take out that put, what contracts I'm opening up on a daily basis, what I'm buying, what I'm selling, when I'm selling, and everything in between, make sure you message me on Instagram. I have a close friends list. Now over 1,900 total paid subscribers as a part of the close friends list. So if you use Instagram a lot and you're familiar with the close friends list on Instagram, that feature, you're going to absolutely love that because you're going to get exclusive premium content to help you build your wealth in the stock market, even if you're a beginner. Super easy stuff to follow along with. Okay, now just to let you know, PayPal is getting a lot of downgrades from analysts, so you can look into that a little bit more on your own time. But a reason for that, regulators announced plans to crack down on buy now, pay later giants, threatening their path to profits. Buy now is the easy part. It's the pay later that gets tricky. Buy now, pay later companies help you sport that $400 coat that designer coat now and pay for it later in monthly installments. Buy now, pay later gain popularity by positioning themselves as a trendier credit card alternative to Gen Z. With fewer strings attached, think no interest, just late fees, and now they're facing serious heat and they can't deal with the later part of their business model. Regulated. Last week, the Consumer Financial Protection Bureau outlined plans to regulate buy now, pay later businesses like Klarna, Affirm. So I'll also watch out for Affirm. And they also highlighted PayPal because I'm pretty sure that PayPal actually works directly with Affirm. Okay, and you can see PayPal's down 3.5% on this news, and Affirm is down 8% on the week. Okay, and also watch out for Block, ticker symbol SQ, Block, because they own Afterpay, which is like Affirm. Very similar business model. Risky business. Regulators said buy now, pay later pose risks to consumers because they lack protections, harvest data, and encourage over borrowing. So long story short, I think there might be a good short-term opportunity on PayPal. I think this kind of news could draw PayPal closer to $75 per share. So that's where I have price alerts set at. That would be a big fall for PayPal from $90 to $85 all the way down to $75 per share. So have your eye out on PayPal. They're still a stock I believe in for long term. I also believe in Square for long term. Those are just both stocks that are going through a rough patch right now. So once everything gets ironed out, and Affirm, for example, I don't really believe in them for long term. I would probably stay away from Affirm indefinitely. But PayPal and Square could be huge buying opportunities in the next couple weeks and couple months. Smash the thumbs up on this video if you want to see PayPal versus Square and which one is the superior stock and a better price right now. Thank you guys for all the love and support you've been showing on the channel, and everyone that has post notifications turned on and smashing the like button on every video. As long as you keep doing that on every video, I will keep making these videos for you guys. Thank you. And if you want to join the close friends list, by the way, and see exactly what I'm buying and selling and everything in between, just message me on Instagram. Simple as that. I reply to every single message. And look over some of the success stories for yourself. Just click on success number 6 or success number 5 on the highlight section of my Instagram. Share this video with a friend if you think they will appreciate it as well. Subscribe with post notifications on if you haven't already. And I'll see you guys in the next video. Remember, don't time the market, buy the market. Peace.